Hey there, everybody. Thomas with Basecamp Trading. It is Tuesday, February 23rd, and we're going to take a look here at the indices, and I want to talk about hedging. Now, this is a tweet I sent out last Friday telling everybody I was hedged in all my positions going into the weekend because we were looking for a sell-off this week, and that if we broke through support, the support was at 38.78 and a quarter. We were looking for a bigger down move, and we'd go net short, and we covered that all today. Now, let's talk about what we mean by hedging and what we can use, some different ways we can hedge our portfolio and the trades that we're taking. First off, all a hedge means is we're offsetting some of our risk. All right. We have something that will do well if the market does bad. So if the market drops, we want to make money with our hedges. And what this does is it allows us to make money on the way down if the market does sell off and offset some of the losses that we have from our longer term holds. And then when the market turns around and starts coming back up, we can take off those hedges. So we will have, by that point, hopefully made money on the way down and then allow our longer term trades to make money on the way back up still. So a couple different tools you can use to hedge. Personally, I had puts in the SPY, I had shorts in the Dow futures, I had longs in VIX and UVXY, and I had calls in SPXU. All of those, I'm flat all of them as of today, except for I have a little bit still short the Dow with the break-even stop because I put them on yesterday. But the other thing you can do, because there's a few people that have told me that they were unable to trade those for some reason. I said, okay, well, another thing you can do is, remember, the further a market runs, the higher the likelihood of a pullback and a correction taking place. So we've had a nice size pullback here in the indices, which is good. Now we're looking for them to head back up because we came right down to our support from the previous pivot low at about 3,800. Now, one of the other things you can do is, as this market starts to get extended, start decreasing your position sizing, and that inherently will start decreasing your average risk. If you stop trading such large positions and start trading smaller positions, then even if it does move against you, it'll be a smaller loss than what your winners were on the way up. All right, so keep that in mind when you're watching this. Also, when we use a hedge, make sure that you have a target for that hedge and you have logic behind it. So in this case, we put on the hedge on Friday over here in the indices. And the reason was we had changed from going higher highs, higher lows in an uptrend on our 120 and 240 minute price chart on the S&P futures till we changed to a downtrend. We went low, lower high, lower low, and we bounced to put in another lower high and couldn't break the previous pivot high. And when we started to roll back down again, we had what we call a bearish momentum zero touch, which is what that purple arrow means. And we started to sell off, and we went ahead and put our hedges on going into the weekend to protect ourselves. So you need to have logic behind it. Now, the target for our trade was the test of the support. And we said, all right, if it bounces off the support, if the support holds, we'll cover our hedges, which is what we did. But if it broke the support, we were looking for 3,700 as the next target. So you still have to treat your hedge as a trade. You don't want to just blindly go put a short position on the market and then just forget about it and leave it. Treat it like a trade, because if you don't, then what will end up happening is you'll just over time lose money on your hedges, and it will have been pointless to use the hedge. All right, because remember, our goal is to make money on the way down and then allow our long-term positions to make money on the way back up. So that's what we did here. That's how it's played out. Now let's talk a little bit about what's next for the indices here. So overall, we've come down and hit our first target, which was that 3,800 level. I don't think we're going to a full-blown bear market or anything like we had in February of last year, or early last year. So what we'll watch for is for this market to roll back down, fail to revisit the lows, and then turn around and head back up, because it is rare for us to have a V top or a V bottom. Normally what you'll do is something like this, where you drop, bounce, drop again, and then turn and climb back up. So right now, we've dropped, we've bounced. I'll actually watch for this throughout the rest of the week, potentially to come back down, fail to break the support again, and then turn around and come back up. And then we'll say, okay, we're back to having a bullish bias and looking for it to head higher. But in the meantime, just cautiously bullish until the trend and everything changes. All right, but hopefully that helps you understand a little bit more about hedging. Again, you can use inverse ETFs, you can use put options, you can go short a market, although I don't personally short. You can use futures and use futures to offset your position. There's all kinds of different options. And the last, if you don't want to just put on a hedge, just decrease position sizing when the market's due for a pullback. When it's due for a correction, decrease the amount of size that you're trading with, and that'll help you do better and have smaller losses when the market does sell off. Now, if you want updates like this, again, I posted this stuff all on my Twitter. I've been talking about hedging for the past week. All right, it's been working out really well. I also post different trade ideas and stuff there. Just follow me at Trades with Tom. But that's it for today. Make sure you like and subscribe for more video content. And until next time, happy trading, everybody.